Hey Amanda, thank you so much for your time. It's absolutely wonderful to have you here today. Amanda is the co-founder and partner at Able Ventures, supporting visionary companies, making the daily lives of people healthier, happier, and more meaningful. And prior to that, Amanda co-founded Videolicious, an enterprise video creation platform, which grew to 5 million users globally and exited to Squarespace. She also has an incredible background in private equity and banking. Amanda, thanks so much for being here.
Excited to be here.
Awesome. You have had the most incredible career across PE and M&A. You've been an operator in the enterprise tech space, and you've now moved to early stage VC on the consumer side of things. I'd love to learn about what informed your journey to early stage investing. I feel like you've been on quite a journey. Wonderful, wonderful journey.
Yeah, absolutely. So I started out my finance career a little bit by accident, but started out in mergers and acquisitions, which is a later stage part of the cycle, working with large multinational companies in their strategic transactions. I went from there to private equity, so a little earlier stage, private, not public companies, although some of those are quite large, especially now. And really found that I loved working in those somewhat smaller companies, being able to get close to the founders, being able to learn about different business models, feeling like I had a real ability to influence outcomes at times. And so that was my first taste of earlier stage investing. And then I really got started at the earliest stages where we focus at Able now, when we had an entrepreneur in residence at Falcon Head Capital, where I was working in private equity in the consumer space, named Karen Banke. And she left that role as an entrepreneur in residence to found a company called Juice Beauty, which is now the largest organic skincare company. And when she left to launch that company, I was lucky enough to be involved and help her early on, and realized that it really combined two things that I figured out I was passionate about. One is working at the earliest stages of a business in that space, and two, what is now called the wellness space. So realized that from a sector perspective, I love consumer, and then this particular vertical of consumer. And then I also loved working with really early stage companies. So I was lucky enough to have a few exit opportunities in some of my early ventures, did some early stage angel investing on my own before going ahead and forming Able Partners as an institutional fund to focus at that stage.
Fantastic. Thank you so much for that overview. I'd love to rewind back to sort of the early years of your career. Like, how did you approach finding your first job out of school? Why banking, or why the choice to move into PE?
So finding my first job out of school, like I said, it was a bit of an accident. So I actually was at the School of Foreign Service at Georgetown undergrad, and thought I was going I was an international econ major, and thought that's really what I wanted to do. And I was in the right place to do it. Worked at the White House, worked for my senator, was a Truman Scholar. And then I had been living in Venezuela in my junior year. And at the time, Merrill Lynch, the investment bank, was privatizing PDVSA, which is the state-run oil company in Venezuela. And that was a huge transaction that had a big impact on the lives of the Venezuelan people. And Merrill Lynch found my resume in the resume stack and asked me to come and talk to their Latin American mergers and acquisitions group. And so I figured it was worth an interview. It was worth a conversation. When they made me the summer job offer, I realized that there was a lot I still didn't know about that sector of the world that was making a big difference in people's lives. I spent the summer there, and at the end of the summer, although I had a lot of hard questions around what I thought was my commitment to public service and what I was going to be doing as an investment banker, it was really clear to me that the pace of learning at a investment bank was going to seemed to be so much greater than anything I had experienced in the public sector, working in Congress, working at the White House. And I felt like that skill set would help me wherever I eventually landed, and agreed to accept a full-time offer in mergers and acquisitions. To start out in Latin America at the time, there wasn't a lot of transaction activity going on there, so transitioned to a generalist M&A analyst banker. I think for students who are thinking about these things, it was a fantastic experience for me. I feel like they paid me to learn for 2 years, quite literally, in some ways, where they did a 3-month summer program where we, I was an international econ major. I'm financially literate, but I certainly did not have any of the specific finance knowledge, which after 2 years of doing that, you certainly walk away with. It's not something it's not something that if you want to have any sort of a life outside of work that you want to do. So it's a great time, in my opinion, to do it right after you graduate college. And then you have a skill set that's like I had hoped would be widely transferable. And for me, finding private equity, working with those companies, that's what I fell in love with, and it was a great setup for that.
That's really fascinating. What an incredible learning opportunity. I think sometimes like you can sort of plan your like college career out and post-college career out all you want, and then things will come in and yeah, sort of change in the blink of an eye. So I really, really love that story. Wondering if your background in banking and PE really comes into handy at the early stage, for example, helping founders determine like exits or public market opportunities. And if so, like how can aspiring early stage investors develop a good knowledge of these things without necessarily having a traditional banking background right out of school?
I definitely don't think you need the traditional banking background out of school. A lot of people will say that venture is an apprenticeship business where you learn by doing. So, the good thing about banking is that they have a lot of seats. They're filling these analyst classes, and if you're looking for a position, they generally will have opportunities for a lot of college students to be able to get that kind of experience. It's a little harder to find that very early stage seat at a venture capital fund. There are fewer venture capital funds. They have a lot fewer people working in that industry, a lot fewer, and a lot less willingness, less infrastructure, I would say, to be able to handle mentoring large groups of recent college grads. So I think that I think that you absolutely don't need something like a banking experience, but to be able to get a seat at a early venture capital fund straight out of undergraduate, I think doing things which it sounds like you and your colleagues are doing, dorm room fund, any sort of exposure or experience that is easily transferable to what you would be doing in that seat is hugely helpful, because there just isn't that same infrastructure to support young graduates as there are in some other areas of finance.
Yeah, incredible. That was really insightful. Thanks so much for that. I'd love to sort of talk about your start at Able and where your thesis of backing inspiring brands that make people's lives better came from. I think that's a really fascinating thesis, and also the fact that you invest in areas that have historical stigma that often result in underserved markets. Like, where was it that you arrived at that passion and thought, wow, this is a really great opportunity for me to jump in and form my own fund?
As everything, it comes from both a personal and a professional standpoint. My mother is a nurse, so I think I always had a holistic view, and she had has a very holistic view of what health and well-being encompasses. So I think I always had an eye out for nutrition, food as medicine, some of these concepts that are now under the broader wellness umbrella. And then professionally, I think about a decade ago, it seemed to be obvious that we were on this trend line, that there is this long-term secular shift in consumer behaviors towards better for you goods and services. And that was going to be a big market opportunity. And so from at Able, we started out with that thesis. We started out with a general wellness lens. And what that meant in the early days was a lot of the consumer packaged good companies like Goop, companies who were the early wellness signalers, like a Moon Juice and a Four Sigmatic. And that category for sure has grown and exploded, as you can see if you go to any even conventional grocery store today. But what we've realized over time, and I think one of the things that we pride ourselves on is being very flexible, and we don't have to be dogmatic about anything. What we've realized over time was that a lot of that wellness seeking behavior, so a lot of those activities, the woman who was spending 2 hours in a rabbit hole on Goop, she was doing that because she was not being served by our current medical system. So there are failures in our medical systems primarily. I mean, if we really wanted to go down that path, we could talk about how women weren't even required to be included in clinical studies in the United States until the 90s. So there are reasons for systemic failures in our healthcare systems, but also failures in some of our systems of support and our food system. So with that, we developed a thesis that we call the wellness gap. And that's something that we define as a disconnect between measures of economic well-being. So if you look at GDP per capita in the United States, which is roughly equivalent to the money people have in their pockets, that's going up and to the right. And if you look over, particularly over the last 20 years, if you're going to put on that same graph a trend line that represents measures of physical and emotional well-being in the United States, very counterintuitively, that has been stagnant to down. So you've created this very literal gap in the graph, and we call that the wellness gap. And we're very interested in supporting the companies that are looking to close that gap. So what does that mean? That means that we're doing a lot at the intersection of consumer and healthcare, and both within the current medical system and new approaches. We have other lenses that we like to look at. For example, lens of stigma, where we think that conditions and communities have been underserved because of historical cultural stigmas. As an example of that, mental health has been a category where we spent probably the most amount of time, a tremendously underserved, large and growing category. So, we are a market rate fund. We are looking for above average returns, but these stigmatized categories that have been underserved, they're large market opportunities and large return potential opportunities as well.
Yeah, no, that's so fascinating. And I imagine that, particularly with COVID and just implications on healthcare and just, the move to like at-home health and healthcare systems, just like already stretched healthcare systems being completely overburdened. I guess there's really a move towards, underserved markets. We all saw how the pandemic really affected communities of color disproportionately. So I really, really resonate with your thesis. I think that's so amazing that you're making this impact while also being able to invest in sort of meet fiduciary duties. I'd love to learn a little bit about, your thoughts around, things like content and community and just like peer-to-peer connections and things like CPG startups and consumer healthcare startups. Is that a trend that you've been seeing emerging, or like what's the real tailwind driving growth in these industries you're backing?
So I'm not sure I 100% I'm answering your question, so redirect me if I'm not, but I think you're touching on a few things. One, in terms of connections and peers and community, I think one of the things that's been driving some of this wellness adoption has been, wellness as a new handbag. So the rise of social media and Instagram, where you can post that you just did your juice fast, not something that I recommend, not good for you, but people are into things like that. Allows you to take an experience that otherwise could not be as signaling as carrying a name brand handbag, and allows you to signal with it. So I think that has driven some of the adoption of wellness, which in many, if not most ways, is an experiential kind of industry. And within wellness, for sure, the community connection, you see it around particular dietary philosophies like keto or like paleo, like a CrossFit community, a lot of overlap between those communities. And you see people, again, using that as a signal of what their values are and what their belief systems are and how they will self-organize their relationships. And then in terms of content that you mentioned, customer acquisition, especially in these direct-to-consumer companies, is the big challenge. Customer acquisition costs have obviously skyrocketed as those fields have become more crowded, and so content for many companies can be a great way to lower their paid customer acquisition costs with really high-quality content that's delivering value to the end user and serving as a way to acquire customers. And then you mentioned peer-to-peer. When I think of peer-to-peer, I think, especially as we shift into more of the medical model, there's a real role for peer-to-peer services to extend the reach of our current healthcare system, extend accessibility and extend affordability by using a peer-to-peer model. I've seen interesting models in recovery from addiction, in mental health support, and other types of support. So I think there's a lot of interesting white space in the peer-to-peer models.
Yeah, this is super interesting. I feel like, if anything, the pandemic sort of resulted in a completely fundamental reworking of the way that healthcare startups are going to operate moving forward. And I think where there are gaps in the traditional healthcare system, I feel like that's where VC really comes in to fill that gap and catalyze that innovation. So I'm so inspired by the work that you're doing and the impact you're creating. I thought this might be a good segue to talking about what it is that you look for in consumer companies that you back. And I know that you've prepped some really great slides on this and advice on advice for founders who are now working to scale up consumer companies. So yeah, I would love to chat about that.
Sure, I'm happy to walk you through a few slides. If you want to enable screen sharing, I can put them on, or they're really just bullet points, so you don't need to see them either. You tell me what's easiest for you.
Absolutely, I will make you co-host. So let me know if you can screen share.
Yep, I should be able to. And if you give me one moment, let's see. And I have to re-enable system preferences. 1 minute. So what I did is I just tried, every VC will have a different way of evaluation, but I have tried to, let's see, you know what, it's not going to be able to record until until it was quit. You might lose me for a minute. I'm not sure. I know you said that this recording is going to be mostly audio, so if it's better,
I'll just edit this. It's all good.
And you might lose me for a minute so that I can present.
Yeah, totally. Hi, welcome back.
Thank you. All right, let's get this. I think now you have to make me co-host again.
Yes, the wonders of Zoom. Are you in office? Are you remotely working as well?
I'm in my home office right now, and at least a 50% chance that one of my 4 kids walks in. So just all right. So like I said, just put together some very high level thoughts on how I as a VC look at venture opportunities, but tried to make it more generalizable. As you mentioned, we are consumer investors. My previous startup, Videolicious, was actually an enterprise software company. So tried to make it more generally applicable than just consumer, although of course that is where my background is and where I'll have the most insight. But I think the big point when we're evaluating venture opportunities as a venture capitalist or any type of investor is that it really depends. And can you see the screen now? Is it working? Good. Okay. Is that how do we evaluate new ventures? It really depends. So like I said, it depends on sector. Consumer investor is going to look for very different metrics than an enterprise investor. If you're looking at hardware versus software, you're looking at a completely different margin structure, types of defensibility, supply chain issues. And the other obvious way, because not all funds are focused on a particular sector, is stage. So you could be looking for venture capital investment theoretically anywhere from a pre-seed stage, which is you don't have a product yet, you maybe just have an idea and a team, all the way to a pre-IPO or a bridge round. And so you're going to have completely different metrics and things that you're able to share depending upon what stage you're in. So the way we will evaluate will look completely different for a pre-launch product where you're not going to have any revenue trends than for something that's been on the market for 5 years already. But one thing that is pretty consistent across different types of venture and different sectors are the team. I think it's really, again, it depends on stage. So at the earliest stages where we tend to invest, often that's the most important thing. And as other investors in our stage will probably likely say as well, it can be a terrible idea and an incredible team, and I will back that all day long before a great idea and a mediocre team. But there are times, and I have made investments where I wasn't in love with the team, but I felt like the category tailwinds were so strong and there was some type of defensibility there that it was worth, if there was not a large number of entrants in the space yet, it was worth taking a bet. So what kinds of things do we talk about when we think about team? The balance of the team. So traditionally people will talk about wanting to see a builder, a marketer, a leader in the team. The idea of a technical co-founder. When we were launching Videolicious, which was a software company, we were told you absolutely need a technical co-founder. So even though my partner was a computer science major from Yale, he didn't fit that description because that hadn't been his primary experience and background. And so we quickly tried to fill that gap, and it turned out to actually not be the right advice for us. So I think take with a grain of salt what people tell you need, but it is important to think about what are the skill sets that are represented on the team. If you are doing direct to consumer, then somebody with really strong marketing experience, absolutely essential. And the team dynamics. There have been businesses that we've passed on because we were uncomfortable with some obvious tension between the co-founders. And when you've got obvious tension 6 months into a venture, that usually doesn't end well. And the data supports that. So Noam Wasserman's book in The Founder's Dilemma says that 65% of startups fail because of team issues. So I think you have to have a really strong eye to that. Other things we're looking at is experience, specific skill sets versus just being a great athlete. I think that depends, again, what sector you're in. So, something like building an enterprise sales team, you want somebody who's done that before, who understands that. If you're selling to enterprise, like, that specific experience is really important. But maybe a general grade athlete is fine for a different type of business. Also, that relates to network. So if you're selling into healthcare payers, then a network in that field would be important. But if you're not, maybe network is less important. Something that I always look for is a demonstrated history of past success in other areas of life. I think that's one of the ways we can diversify the founder pool. You don't have to have shown a great business success in the past. Where did you have some great achievements in the military, as an athlete, in other areas of life? I think that skill set is very transferable to entrepreneurship. So I'm always looking for demonstrated excellence in some area of your life. It doesn't have to be specifically related to the business that you're building. There are obviously soft factors like coachability, commitment, grit. And something that I think is very important and sometimes overlooked is the personal connection to the story or founder company fit, which, there are a lot of MBAs who find a white space and go to build it. And some of those companies are successful. I won't say that they all fail, but I think a founder who has a real personal connection to what they're building will, just by virtue of that connection, have more grit, have more motivation, have more durability through the inevitable ups and downs of a venture building. So, and just have more authenticity, which tends to lead to better outcomes. So that's something that I'm always looking for. And then the last thing that came to mind is other sort of signaling in the person's background. So that could be the university you went to, that could be affiliation as an employee or otherwise at a past successful startup. It could be that that person was vouched for by a founder that we've already invested in and that we really like, an investor that we know, somebody in the industry that we rely on. But I will say it's, real life always trumps pedigree. So all the Harvard degrees in the world won't be as meaningful as somebody who's built a past successful startup. That will always trump pedigree. And I just want to point out that I think we have to be aware how an over focus on some of these signaling items could lead to what we have right now, which is, a somewhat homogenous founder pool. So when we think about diversifying the founder pool, just have to think about how our reliance on signaling plays into that. And so the next question I'm going to ask when somebody comes to my desk with a pitch deck is, are you solving a real problem? Is what you're telling me that you're out, what the product is meant to be? Is that an actual problem? What's the big opportunity? And show me with as much third-party validation as possible that that's actually a problem. Third-party validation could be research reports, but it could be surveys, formal or informal. It could be showing how people are doing workarounds right now to get to the same outcome that your product would solve. And there has to be something behind that opportunity that you're telling me about, beyond just you telling me that it's an opportunity. And then why aren't the current solutions working? It's a problem, but maybe there are other solutions on the market. Why have they failed? How are you going to be different? And then tell me who has this problem. Give me your persona. Give me who you think the person who has this problem is and who will be your customer. And then the final question that people need to look at is, is solving this problem, are you giving people a vitamin or a painkiller? Because it's much easier to sell a painkiller. So everybody knows vitamins are good for you, but it's not going to give you that immediate effect. When you have that headache and you want to take Tylenol, I'd rather be selling Tylenol than my daily multivitamin. So those are, to me, this is one of the biggest things that comes across my desk. There can be all sorts of great little cute solutions, but you might not actually be solving as big of a problem as you think you are. And then to that point, are you solving a problem that's actually big enough? So you could be solving a problem that really exists, but it exists for such a small number of people that it doesn't scale to a big business. So scalability is an overlay that we look at with all of these questions. And so I want to know if you're solving a problem for Harvard, seniors, that's great. You might be solving a real problem. You might get 80% market penetration with Harvard seniors, but if you are not able to show me that this problem is important to all college seniors or an even broader group of people, then it doesn't really matter how great that solution actually is. So this relates back to market sizing, or TAM, as people often call it, total addressable market. You can calculate that top down or bottoms up. So you can actually go and say, the software industry is this large, and we expect to, the enterprise software industry for this sector is this large, and we expect to take X% of it. Or you can do a bottoms up analysis where you're actually building it from the individuals who will need your product by what their spending and behaviors are. But the rule of thumb we want to look at, people throw around a market opportunity of at least $1 billion. And I would say that, I think you want to make sure that the bigger that market opportunity is, the better, because there's no company that's going to capture 100%, and most companies won't even capture double-digit percentages of any market size. So to be able to be comfortable that the company can scale to the size that a venture capitalist wants to see, you want to show that the size of the pie is big enough. And then one thing I just point out is that this analysis, which is pretty core to most venture capital analysis of companies, is flawed when it comes to category creators. So, you can tell me what the market size is for, caffeinated beverages in the morning, but, Keurig K-cups, that was a completely new invention. There wasn't a market for Keurig K-cups. So in that case, you have to talk about what's the market of people making coffee at home. Maybe you're going to eat into some of the market of people who would have otherwise gone to a Dunkin' Donuts or a Starbucks, and you're going to have to create an entirely new category, something like Twitter. How do you even think about what that market opportunity was when that was launched? It was something that didn't exist before. So even though market sizing is a really important thing that we look at, it's not necessarily relevant to every company. And some of the most exciting companies, in my opinion, are the category creators. So just another couple points there. When you're talking about market size, I think if your initial market isn't huge, you can build in a scope expansion in your market size. So talking about the fact that you wedge into a larger market, I get trust from my consumer here, and then I can move them there. And so that's something that can be a way to work around what might look initially like a market that's too small. Another way to do that is say that the market's small today, but it's growing very quickly. And that certainly in a lot of the consumer products companies has been the case, and the way they've become successful. If you look like something like Halo Top, the high-fat ice cream, that really wasn't a thing before they created it, and that market really grew with them. And then the last point that I like to think about is market readiness. So you might have a solution, but are people willing to pay for it? Is the market there? It might be something that makes a lot of sense in 10 years, but is your timing right today? So that's something that as venture capitalists we like to look at. And then also core to this analysis is, what is your moat? So that's really, what's your competitive advantage and what's the durability of that lead? So, barring unique regulatory or patent protection, no company has a perfectly defensible business model. So, a big red flag in a venture meeting will be when we ask about competition, and people do this all the time. They say, we have no competition. We will have no competition. I'm not worried about anything. That to me is a big red flag. So, tell me though, what does give you some competitive advantage, and how long you think that will last for? Is it a superior product? But how is it a superior product? Are you giving better customer service, better branding? Do you have a better cost structure? Is it higher quality? Is it more available via distribution? So really thinking about what are the differences there. Some of the most common competitive advantages, IP. So certainly if you could have a patent or even just general know-how, sometimes a lot less valuable than people think it is, but that's sort of a classic example of a competitive advantage. Your team, you might have put together a team that, for example, we work in the mental health space, and when we invested in a company with one of the great leaders in the space, and one of their key objectives was recruiting practitioners onto their platform, we said that that's a moat, because she has a reputation and she has a network that is not easily replicable by others. And so that team is actually part of their competitive advantage. Similarly, relationships, as I mentioned before, if you're an insurance company, if you're selling to insurance company buyers, if you're selling to retailers, if you have relationships in those spaces, that can be a source of durable competitive advantage. And many of these are well-known economies of scale and scope. That's something that would obviously happen over time. But I think even in the consumer space, something like a supply chain relationship can be overlooked. Two interesting examples in that space. If you look at high-end fashion companies, so there's actually difficulty using sourcing leather for high-end fashion, because pretty much all leather used in high-end fashion is a byproduct of meat, animals raised for meat consumption. So what have some of the high-end fashion houses done? They've actually bought those cattle farms. So they're obviously not in the meat business, but that allows them to control the supply chain. That's a source of advantage. A company in our portfolio, Daily Harvest, they have built out forward purchase agreements and have actually helped farmers transition to regenerative agriculture. And so they develop these long-term relationships with farmers that allow them to get source this variety of organic produce, because they have built those relationships. And that's a unique source of advantage that we don't necessarily see very often in the consumer space, but I think is very meaningful. And so one other thing we're going to look at your channel strategy, talk about what your gross margin is versus your cost to distribute or sell. Direct to consumer obviously has had a huge acceleration in the formation of new companies in that space. I think the initial pitch that you were going to take out the retailer margin and sell to consumers directly was compelling, but as that space became more crowded, we saw that your customer acquisition costs did not scale as well as you had hoped, and therefore what you were paying in customer acquisition costs was sometimes more expensive than a retailer distribution margin would have been. So you want to think about those things. How does your channel scale? How does your customer acquisition scale? And you want to make sure, as I've said before about this, that your team matches your channel strategy. Do you need marketing expertise? Do you need enterprise sales expertise? Wow, this is taking longer than I thought. And then the competitive landscape, sort of obvious, but we're going to identify the competitors. Feel free to do it for us if you have a competitor page and we know of a couple of people, and this happens all the time. If it's a space that we know well enough, and in our minds, we think we know who would be competitive or who we would be worried about, and you're leaving off some of those people, I'm going to really question why. And then you want to figure out if this company is best positioned to win, because there will always be competition. Again, it's a big red flag if somebody says there's no competition in the space. So there's other questions that you'll often get around competition, but I think you want to be not defensive and as transparent as possible while still being confident in your abilities to win. Business model economics, a very obvious one. Is this business profitable on a unit economics basis? If I look at one unit of production, one service provided, does this business make money? And if not, how big do you have to get? When does that happen? So if you look at Uber, they have been at times losing money on every ride. So, obviously they have a strategy to build through scale, eventual profitability and market dominance. But as a VC, we want to know, are you realistic about what you're going to achieve? How much growth, how much scale do you think you need to get before this business makes sense? Similarly, if it will be a capital intensive business because of either ongoing operating losses or other capital investments needed, how much are we going to be diluted in further rounds? My mind goes to, as an early stage investor, if you're going to have to raise hundreds of millions of dollars, my stake is going to be diluted to such a small amount. Will this still make sense for me? And in a business like that, you want to know, is fundraising a core competency? And if so, does this team have that competency? traction, I think for this audience, if you're very early stage, I doubt you will necessarily have some of the traditional financial metrics like sales, growth rates, run rates. But there's a lot that you can show. You can show proof of concepts. You can show, you really want to think about what's the minimum that you can do to show some interest in your product and show something. So is it traffic? Are you asking people to sign up for a newsletter or sign up for a wait list that's indicative of interest? If they are signing up for a wait list, is it a paid wait list? Is it a free wait list? How are they engaging? Some of these other metrics are more relevant for later stage companies, but no matter how early stage the company is, you can get creative about how you're showing traction at that point. And then, beyond that, sort of last slide, and I don't put too much time on this, but it's something that's going to be at the back of your mind. What are the exit opportunities here? Is this an industry that historically has been very acquisitive? There are investments we've made where we know that the company doesn't have to be a huge success, but if this technology is meaningful, it will be a very logical acquisition target, and that gets us comfortable in the downside scenario. Or is an IPO the only logical exit for the type of business you're building? And do we feel like this is the type of business that would scale to that size? So one last note I just want to say is, like, our job as venture capitalists, unfortunately, is a lot of saying no. You'll see 1,000 or more deals a year. We're only going to do a handful of them. And so, you'll be rejected if you're going to go down this route, but I would say absolutely don't take it personally. There are so many examples of huge successes, unicorn companies that were turned down by lots of famous name brand VCs, and that is absolutely not a judgment on the quality of you as a founder or as a company. But I would say look for the learning. So you don't take it personally, but I think you also want to try to find the value in every conversation you have with investors. So we raised 7 rounds of funding for Videolicious. We heard a lot of no's to get to a few yeses. And I had a philosophy that every meeting, even if I didn't think the investor knew anything about my space, I could learn something. And very often you did. You learned at least one thing from every meeting. So I think that's the kind of mindset that you want to have. And then the last thing I'll say is no doesn't always mean no. It could mean not right now. And so be gracious, be transparent, and when you get that rejection, ask if you can continue to keep them updated on your progress as you move along your founder journey. And you might find that you actually have a productive fundraising conversation later on in your fundraising stage. And so the last thing I just want to leave you with is that venture capital is not the only option. I think we have a real glorification of venture funding in this country right now, shows like Silicon Valley. But venture capital isn't the only option. First you want to ask yourself, is what I'm building really the right fit for venture capital? And the companies that are the right fit for venture capital are really very high growth companies that are going to have high risk, that are probably likely to fail, but need a lot of outside capital to shoot for their goals. But there are other types of businesses that are equally valid and wouldn't be a good fit for venture capital and should absolutely be in our toolkit of what we're thinking about as founders. There are what we call lifestyle businesses, where you're really aiming to provide a good living for yourself and your family, but you don't need to be shooting for $1 billion valuation eventually, and therefore you don't need to take outside capital. Or of course the side hustle, where you might have a different daytime job focus, but this is something that maybe comes out of a passion or an interest of yours. It can supplement your income. It can be interesting, but obviously not a fit for venture capital. And some other areas of funding: bootstrapping, self-funding the business based on your own revenues, friends and family. Obviously not everybody has friends and family who can support a business like this. I would expand that to say friends and family and old bosses. Both my partner and I were lucky enough to receive funding from our former bosses at other jobs. Angel investors networks. There's some great Harvard angel networks that you should definitely be exploring. Product or equity crowdfunding, depending on the type of business that you're launching. And there's some outside the box ideas like factoring, grants, small business loans, et cetera. So that is my short but a very quickly shared version of how we tend to look at new ventures that hit our desk. And I think those are a lot of the themes that most investors tend to look at.
That's incredible. That was so, so helpful. Thank you so much. Do you mind if we shared that slide deck out to our like collegiate community? Would that be possible?
Let me look through it. I just threw that together today, so I want to make sure it actually is coherent and makes sense. But
Oh my gosh, it
certainly,
made so much sense. Like it looks great as is. So you honestly like there's no pressure at all to have to spend any more time on it. It looks really good. So I think
thank
it'd be a
you.
really helpful resource. I think that, you know, like our analysts and associates do go through some level of diligence training, but I think you brought up some really, really interesting points around, you know, not all businesses are sort of venture backable. Things like when we look for team, like we can't index very rigidly on some of those metrics because sometimes you're overlooking really promising founders. Like I thought those are really interesting points. Had a couple of questions about that actually. Like I know that you are really big on, you know, focusing on underrepresented markets, to some extent underrepresented founders. Like what do you think it really takes to lead change in the makeup of VC investments flowing to underrepresented founders, be it women or Black founders?
Yeah, I mean, there's some things that we have data around where we know that if you have, for example, a woman investment on the investment team, in particular, a woman with check writing ability, which is a big difference than just being on the team, then they will fund more women. So part of diversifying the founders that get funded is diversifying the investors. So we could go into a whole sidetrack on that and what it takes to diversify the investor community, because that will have the obvious outcome of diversifying the founders that get funded. I think that it's really important that we continue, like I said, to look at other ways to validate what a successful founder could look like. So making sure that we're not, for example, needing to see a certain type of certification or needing to make sure it was a warm introduction from somebody who's already in our network who introduced us to somebody. But I think if we take a step back, the question and the problem can be even deeper, which is we ran an accelerator for early stage founders. And we realized that even though we were focusing at the very early stage of business formation, in most cases, the gap was even earlier and broader than that. We got 850 applications from businesses, and we realized that so many of them needed even some of the basic business background and understanding and coaching that you as a Harvard grad might have a lot more insight into than somebody who took a different career path. So again, they might have a lot of the raw talent to be an entrepreneur and a business person, but their ability to have a conversation or even to think about how to structure their business so that eventually becomes institutionally fundable, there's just some basic knowledge gap there. And how can we start increasing the educational resources? And then I would say it's not just a knowledge gap and educational resources that are needed. If you look at what most founders have to do, most founders don't take salaries or take a de minimis salary in the first few years of building their business as they're waiting to get some traction, get it off the ground. I mean, that is not an option available to most people to work without pay for any period of time or to work at a below market pay. So I think we need to think about what are other types of structures we can develop so we can take some of these promising founders and give them the freedom to actually go start a company without that same type of economic pressure that you would have. So, I think there's a lot that we need to think about. There's a lot that needs to be done to change the venture model.
Yeah, absolutely. I think really tackling it from the ground up, sort of thinking about it's almost like a supply issue, isn't it? Or like, I think often it's really difficult to find really promising sort of diamonds in the rough unless you're really entrenched into those networks. And even when you're really entrenched into those networks, it's almost as if there's a bit of an echo chamber. Like, you tend to gravitate towards founders who are in industries that you know really well, rather than promising founders who, you might not have it at the back of your mind to sort of go out and have conversations with them. So I think that's really, really fascinating. And I think something that we definitely want to do moving forward at Collegiate, just like making sure that we're not just focusing on schools where there's a certain threshold of education, but also being able to offer entrepreneurial resources and a way to give back to the community. So I love that. Wanted to end on a question of just about you, like, you've made incredible waves in VC, actually, incredible waves in multiple areas, like multiple industries. I feel like you've been in a career journey and you've honestly made waves in sort of every single step. What's been the key to your success, whether it's like a habit that you can't go without or a framework for thinking or career growth?
Yeah, I mean, I don't know. I mean, when I think about, it's easier to focus on what you haven't done than what you have done. And I think for me, what has been most successful and also has been related to my greatest failings have been just following my curiosity. So, there's so much of being an early stage investor is about identifying something that is not a big deal now, but will be one day. And so I think that it is easy, especially in the venture community. There's a lot of inside baseball. There's a lot of echo chamber. There's a lot of lemming-like behavior. And so I think I've been lucky that I took this sort of differentiated career path where I was a founder, where I raised a SPAC, where I was in private equity and M&A. So I didn't necessarily grow up in the venture capital world that allows me to take a more eclectic approach to what's interesting. And I think that some of the big opportunities I've missed out on is when something was personally interesting to me, I was very curious about, but I didn't think it fit within my investment mandate or within the investment world, and later became a really big deal, Bitcoin, for example, and other things where I think I did follow my curiosity, even though on the surface it really didn't make sense, something like therapeutic psychedelics. That became a big success. So, for me personally, it's something that I just try to remind myself, if I have curiosity, it doesn't have to fit in a bucket. I don't have to feel like it's something that's on the path that I've laid out for myself. I have to give myself permission to, take those detours and spend that time on something that doesn't have an immediate outcome or immediate payoff. But I have to just trust that ultimately there's some value in that.
Yeah, that's incredible advice. I think, yeah, all of us can stand to take away something from just curiosity and being really authentic and sort of following where our interests take us. So I really, really love that. Thank you so much for your time. I know Claire has a question. Claire, do you want to shoot it across in the chat or unmute if you can?
Hi, thanks so much for coming today, Amanda. Really appreciate the time. Sorry I came in late, just running from dinner, but if you do have time for one more question, I'd love to ask you something.
Sure, I think we have time.
Lovely. So my question is, I think I've been to a few different kind of venture capital or different like startup founder networking events so far. And every now and then, I think I run into this kind of small issue of sometimes feeling like maybe I'm one of like very few girls there. And I kind of run into, I know it's often referred to as kind of like a boys club, this kind of culture of like, a lot of like tech bros, like talking it up. And I was just kind of wondering if you had any advice for someone like me, whether that's women or just other kind of archetypes maybe don't feel as comfortable, I guess, coming into that kind of environment when it comes to like these different events, and even when it comes to simply, founding, finding co-founders, raising funding, talking with VCs, maybe a different like approach, whether that's kind of integrating into this kind of community somehow, just knowing the lingo and knowing your stuff really, really well, or whether that's maybe going about it from a different angle.
Yeah, I mean, it's sad to me that even, I guess, your generation that you're coming across that. I mean, I remember as a founder, as a pregnant founder, going to some tech events and feeling like I was an alien. Like I literally, there was nothing worse, nobody like me. And so I hear that. I think ultimately you're not going to blend in. No matter what you do, you're not going to be one of them. But I do think, as much as I sort of hate that this is the case, but learning the lingo is important. So I think having those conversations, being able to understand what they're referring to, whether that's listening to industry podcasts, reading industry newsletters, or continuing to go to those events, so that you can at least be fluent in those conversations, so that they very quickly stop seeing you as different and hopefully just see for whatever contribution you have. Of course, the best way to succeed is just to be successful. So if you build a business that has interesting metrics, then you will hopefully get funded. You will hopefully have success. So I think, unfortunately, that doesn't mean that there won't be more friction and you won't have to work potentially harder to do that. I've mentioned before publicly, but I remember when a founder of ours was pregnant and fundraising and had amazing metrics. But when I talked to some other VCs about why they didn't want to back her, they said, oh, it's, she's pregnant. And so, that still exists. But I think, having this Harvard pedigree, like that's incredible. Like I had a male co-founder, can tell you all sorts of stories about how experienced a lot of uncomfortable situations. But I had the Harvard degree, and I have to tell you that was a lot of signaling power there. So I feel like that balanced things out to a certain extent. I think you just have to walk in and know that in general, the people who have been most successful are not the average person. So they aren't average in any way. They aren't going to be the average founder. They aren't going to be the average VC investor. We talk about this a lot, what type of founder profiles are successful, or even investor profiles are successful, and they tend not to be the typical. So, embrace the fact that you don't look like everyone else in the room, and that gives you unique advantages. We like to say 70% of our portfolio has a female founder, and we don't do that because we're trying to run any sort of a philanthropy. We still have top tier returns. We do that because there's an arbitrage opportunity. We know that women, by any number of metrics, outperform all male founding teams by significant amounts, and yet solo female founders receive around 2% of venture capital funding. So that feels like a real arbitrage opportunity from the investor's perspective. And from a founder's perspective, if you're investing in our space like consumer, we know that over 70% of consumer dollars are controlled by women. So why wouldn't I actually have a bit of a bias towards a female founder who represents a demographic who really has the wallet there? So, I think you can lean into your differences too, where it makes sense. But I think you have to acknowledge that, there are some struggles that come with that. And the last thing I would say is, when you're in a position of power and you've been successful, just remember that and make sure that you're doing what you can to pull up others behind you.
Got it. Thanks so much, Amanda. No, that definitely, I think, lends me and everyone else who hears this podcast in the future a vote of confidence.
Great.
Yeah, I know we're at the hour, and I just wanted to say a massive thank you for all of your time today. I think your slides are absolutely amazing. I think there's a lot of helpful nuggets of advice in there for people looking at being founders or being investors in the future. I am honestly such a fan of your work, just like advocating for other women in the workplace, but also being able to advocate for underrepresented founders, underrepresented markets, underrepresented communities. I think it's not every day that you have an investor who is so passionate about making impact without also sacrificing like returns on investment. So I think that's awesome what you do. Thank you so much.
Thank you for having me. Good luck with finals, everybody.
All right. Thank you.